Emergency investor warning. NATO goes nuclear on Russia, imposing the swift ban on their central bank. Now, they are still letting them sell energy at this point. And I think these bans are slowly taking place. We're seeing bank runs in Russia. Their currency collapsed overnight. It is rebounding a little bit today as they're offering a 20% interest rate and they're freezing assets. Russians are not allowing their people to convert currencies now, which I think is what's causing massive money to flow into crypto. People want to get out of these regulated financial systems and off the grid. The Russian stock market's now imploded 50% in the past 5 days. Good thing we didn't jump into that last week. Probably won't, not unless there's a regime change or a major peace negotiation. Today they did have a negotiation. It failed. They're supposed to meet back up in a few more days. I think Putin was just buying time, or perhaps both sides. Right now we can see a 27-mile long envoy marching to Kiev, Ukraine, the capital, as we record this video. So far, Putin is being made fun of as having a failed military attack, but it does look like he's been taking it quite easy in terms of using heavy weaponry. And that's the problem. Russia may soon be acting as though they're trapped. They could begin escalating the situation. The easiest way would be to cut off natural gas to Europe. They would quite likely freeze to death right now. And then they could begin using some of their heavy weaponry to destroy targets, which thus far they've been holding back on. So we're still heavily hedged against these risks. And we want to teach you today how to protect your wealth. And we've got a simple 3-stock portfolio that does the trick for massive gains this year. So what we're going to review right now is how to invest every $10,000. If you had 100,000, just add an extra 0 to each position. If you had 50,000, multiply by 5, you'll get the point. Okay, step 1 is you want to own crash insurance. You don't want an inverse ETF. You want crash insurance. The only asset that does this is UVXY. For every $10,000, you'd be putting in 86 shares of UVXY. What UVXY does, it's the volatility index. And so if stocks drop at an accelerating pace, bottom line, if we get a panic, a black swan, everybody hits the sell button at once, we hit some limit down days during the market, during futures markets, that's what makes UVXY go up faster than your stocks go down, which is important. It allows us to be long stocks and just not worry about really bad outcomes where we could lose half our wealth. And again, in March of 2020, when people were getting margin calls, this puppy went up 1,100%. So just a 10% position starting in February 19th, before everybody was freaking out, would have completely protected your portfolio. So we're over 10% currently because the risks are high. Now, I see Treasury yields falling in almost every outcome. If we de-escalate, energy costs are going to fall, yields go down. If we escalate, people are going to still go to that safe haven Treasury asset. So this is a win-win to be long growth assets in the face of this conflict. The best growth asset by far is ETHE, the Grayscale Trust for Ethereum. We're very bullish in this asset over the next decade and do believe you can make well over 10 times your money holding this. In fact, we may see a double or triple in valuation just this year alone. It's a beautiful setup with what the Canadians have been doing, with what the US is doing to Russia, kicking people out of their money, not letting money flow. It's just making people wake up and get their money out of the system before it happens to you. Okay, and so buying into Ethereum is like getting into Windows or Bitcoin in the very, very early days. Okay, so this is a brand new technology, it has decades of growth ahead before it really matures. And here's a look at the chart of Ethereum. Just over 4 years, it returned as of taking this screenshot. And you could see it already sold off about 50% from the high. But from that point, it was already up 18,000%. Okay, so you grew your wealth 180 times. Just incredible. And it's actually doing what it's promised to do now. It's creating a DeFi financialized system where you can borrow money, you can buy insurance, you can do a whole lot of stuff. And it is alive with billions and billions of dollars flowing through it. In fact, hundreds of billions. Now, the best way to get exposure is to buy the Grayscale Trust ETHE. It's actually trading at 20% discount compared to the values of this trust right now. So you could actually outperform Ethereum to the upside if you get into this position right now as it closes that discount window. So ETHE Grayscale Trust is your next position. And again, this is 217 shares. So for every 86 shares of UVXY, you need to be simultaneously buying 217 shares of ETHE. You do the two trades at the same time. And then we got to realize we're in a rate hike cycle. We're in an inflationary period, and China is about to start printing money. Every time this has happened, the last two times the US was hiking rates, the best performing asset was natural gas, okay, outside of Bitcoin, which we'll look at in a second. So this is a good position as an inflation hedge over the next 2 to 3 years, but it's also what Russia can do to fight back against sanctions, which we have not yet seen their moves. And if they don't get what they want, which is a neutral Ukraine, and to bring back all the weaponry, that's really what they're asking for. They're likely going to start messing around with energy in Europe. And so right now, oil's trading way below its recent high before this conflict erupted, and is where I see the big gain ahead. We've already seen wheat going up, skyrocketing, oil on the verge of going above 100. Palladium, all of their exports are already at peak pricing. The only one that hasn't made the massive move yet is natural gas. And we're going to be approaching the perfect time for Putin to play that card. So that's our hedge against inflation, against Putin, in terms of retaliating against sanctions right now with 97 shares of oil. So let's just repeat. Step one, you buy 86 shares of your crash insurance, UVXY. Step two, you pick up 217 shares of ETHE. And then step three, you buy 97 shares of BOIL. That's a leverage play on the price of natural gas. That's US gas. So if Russia cuts off gas to Europe, the US is going to start exporting our gas at very high prices, just like we did last year to save Europe. So beautiful setup. The recent high on BOIL was in the 90s, and today it's only at 35. So we could easily double, triple, quadruple, maybe even more if this conflict really spirals out of control. And so far it is spiraling out of control. We just haven't seen a complete panic in markets yet, and we haven't seen Russia go super aggressive. Now, this strategy last year did return 233%, turning every $10,000 into $33,000. There were many slow periods, but boy, oh boy, when you have your line in the water, you can catch the big fish with this strategy. Let's look at it on a table so we can look at this in one nice page. If we look at the asset allocation, we're currently 15% in UVXY. More than enough to make a massive amount of money if we get a panic black swan stock market crash. Okay, next position we call growth. This tends to do well if bond yields fall. And that asset is Ethereum with Grayscale Trust ETHE. That's where we really want to make the most money over the next decade. All the other positions are simply there to protect our growth asset, because we understand technology is revolutionizing the world, and that's where you're going to get the big gains, the big growth over time. There's just things that can get in its way and create volatility in the short term. And that's going to be margin calls, people losing money, having to sell things just to stay alive. That's where UVXY plays out. And then we have the threat of inflation driving up energy costs, driving interest rates higher. So that's really your bond crash hedge with oil. And again, it's also the card Putin can play to inflict significant pain on global markets. So yeah, if he does cut off energy, a lot of problems happen. And that primarily is the bond market crashing with oil, stock market or margin calls. People run out of dollars because they're losing too much money on another play. UVXY, it can cause systemic selling across all assets. Now, I still believe that we're going to see a de-escalation within 2 to 4 weeks or less. Russia's going to run out of money. They are really feeling the pain right now. So I'm closely monitoring for any signs of a de-escalation so that we can quickly dump probably 2/3 of UVXY and all of oil, and then rotate into some safer plays and definitely get more aggressive on Ethereum. But until that de-escalation occurs, we need to be cautious, patient, and have the two hedges in play. The second the de-escalation occurs, expect oil to fall back down. And that's going to make yields fall, and that's going to make technology stocks rip higher. And that's where we want to be betting our money long term. Falling bond yields, most likely moonshot cryptos. Now today, guess what? We've got the TLT up 2%, which means bond yields are falling pretty rapidly. And Bitcoin's up 10.5%, Ethereum's up 7.9. Okay, then you throw on top of that that governments and NATO are cutting countries and specific people out of the money system. Well, of course, they're going to the DeFi, decentralized money system, which is Bitcoin. Also, we need to pay attention. There's a big credit expansion starting from China during a US rate hike cycle, which is going to be announced March 15th through the 18th. I believe we will have a dovish surprise of only a 25 basis point hike rather than 50 basis points, which the bond market will like. And that means be long cryptocurrencies. The other asset we really like over this cycle will be emerging markets. We have seen some pretty surprising drops in European and Asian equities over this Russia conflict, which makes sense. But as that de-escalates and we see the US tightening, having a hard time passing more stimulus, perhaps going to a gridlock government after midterms, almost certainly, the US is going to slow down its spending. Europe likely is going to keep quantitative easing going hardcore with all these disruptions to their economy, and Asia's already easing. So with our clients, we have two strategies, one we call safe growth, and then we have one called high risk. We recommend 70% of your assets being in the safe growth strategy, which you only get access to when you upgrade your free trial, and then 30% of your portfolio in our high risk strategy. And so during this coming cycle, we do see outperformance in most likely Asia and perhaps Europe with this new expansion of quantitative easing that's going to be called on. Now, what happens when the US central bank hikes interest rates for several years? That's what's coming down the pipeline, almost certainly. Well, the net effect is it makes the bond market unattractive and it drives yields higher, and it forces investors into the assets we like to be long currently. And I want you to know that the last time this happened, Bitcoin returned 4,400%, a 44-time return. The big picture is this: global economy is slowing down. The US has not had stimulus for over a year. The last big stimulus was $3 trillion, and that's starting to slow down. I'm expecting peak inflation by March. And the only caveat to that is we do need to get energy costs down. So the longer this Russian thing goes on, the longer energy costs are going to be problematic for inflation. So in general, outside of these energy costs, I believe the bond market sell-off that we've had from December through current that we saw last year is about to reverse course. Energy costs are going to fall, inflation is going to cool off, and this propels Ethereum to new highs in 2022. So when we look at the big picture and we really look further into the future, governments are spending more money than they make. devaluing their currencies and their debts. And bonds are still very ugly, especially with this sell-off in bond yields today. Your 30-year is now at 2.1%, but the inflation rate's at 7.5%. So until those two get much, much closer, we're better off being long the opposite of the cash or bond position. So we want to be in an inflationary position. So the CPI needs to start falling rapidly for the bond market to stop panicking. And if this happens, investors have no other logical option until those yields do hit peak interest rates, which align with inflation. So right now we want to be long stocks, crypto, and commodities, and that these will melt up until the bond market becomes attractive. So watch our webinar every Monday, Wednesday, Friday to be ready for sell alerts. Now, if you're on a free trial, you get the entry, but you don't get the exit. You have to call Dean to upgrade and gain access to the sell alerts plus the membership area where you get the safe growth strategy for 70% of your money. And then you get the high risk strategy for 30%. So call Dean right now to upgrade at 505-322-7515. That's 505-322-7515. All right, let's go ahead and hop into the news feed. Okay, Jim Bianco says February 22 started with the financial crackdown of Canadian truckers and ended with the financial crackdown of all of Russia. The financial system has been weaponized. It cannot be undone. It matters a great deal for both TradeFi and crypto. Biden to offer plan for energy, childcare, and health costs. More stimulus, Zero Hedge asks. Durian Timmer of Fidelity says, the message from the markets is clear, as tragic and infuriating as the news of the past few days has been. It's unlikely to throw the Fed too much off course in terms of its widely anticipated rate hike cycle, but this is all moving target. His model shows the peak 10-year at 2.35 and that it hits around December of 2023. That's exactly what I'm expecting in terms of timeline and peak interest rate. So we'll have to watch this play out. So anyways, we've basically got a long time before we would consider any other positioning outside of how we are currently investing assets. Putin's ban on foreign debt service may mean $478 billion default. President Putin banned all Russian residents from transferring hard currency abroad, including for servicing foreign loan contracts, putting much of the country's $478 billion in external debt at risk of default. U.S. State Department says U.S. will do more on sanctions, as it has seen no indication that Russia is prepared to de-escalate. Ouch, MSCI says removing Russia from the indexes is a natural next step. More than $920 billion is in the EM ETFs alone. Russia has a weighting of 2.7% or $24 billion. Perhaps that's why we're seeing a little bit of a pullback in EEM that was beyond normal. Biden says Americans should not be worried about nuclear war. A little snapshot of the assets today, getting a big bid on Tesla, of all things. I'm going to try to not get too political on what's going with the Ukraine-Russia. So we'll skip that slide. Salmon prices skyrocketing. Clint Elrich, what we're witnessing is a funhouse mirror version of the Gulf War. During that conflict, images of smart bombing broadcast into American homes highlighted U.S. dominance. Today, Twitter images of Ukrainian tactical successes are creating a false narrative of Russian defeat. Here's our premiums on Grayscale. So you're getting a discount of 20% on GBTC, which we're big on in the safe growth strategy. And in our high risk strategy, we're going long ETHE. So both of those could outperform the underlying asset in the very short term if these assets keep rising. Mark Rubio, growing signs Putin has ordered a medieval siege of Kiev, cut a city of millions off from food, fuel, power, communications, and supplies, then bomb and starve the government into submission. We need to start thinking about what we can and are willing to do to prevent such a barbaric crime. Meanwhile, we have a US trucker convoy growing in size heading towards DC. 17-mile Russian convoy en route to Kiev, New York Times. Russia says EU sanctions won't be left unanswered. Russian Foreign Ministry says Germany's decision to supply Ukraine with lethal weapons is outrageous. And again, that's who they could directly cut off of natural gas. Russian Foreign Ministry says those supplying lethal weapons to Ukraine will bear responsibility should these weapons be used during Russia's military operation. ALF, the Fed expects to end the hiking cycle around their estimated neutral rate of 2.5%, still too high in his humble opinion. Watch out for any statement of hiking above neutral or attempts to raise the long-term neutral rate itself towards 3%. The bond market would take that very seriously. We got Powell speaking this week to the Senate, I believe, but the important FOMC decision to end QE and do the first rate hike is, I believe, March 15th through the 18th. So he's saying basically we want to make sure their neutral rate remains at 2.5, that they're not thinking they need to rise it to a higher level to fight inflation down. And again, I'm thinking there may only be a 25 basis point hike coming up. Bill Ackman, who seems to have very interesting tweets targeted at the media that perhaps aligns with political interests, says, POTUS, is there a point at which and he's a big hedge fund manager, definitely with inside knowledge, and he's been very aggressive in recommending rate hikes for several months now, including a 50 basis point rate hike to begin. Is there a point at which we say it is un-American to sit back and watch this transpire? We are fighting an economic war with Russia. We are supplying weapons and intelligence with our allies. And the Ukrainians are putting up an incredible fight. The Russian army has shown itself to be weak and lacking morale. Their air force can't achieve air superiority. Putin is rallying with nuclear saber as he gets more desperate. What if? Do we wait for him to kill millions before we intervene? What precedent are we continuing to set by allowing this to play out? None of us wants to put American lives at risk. And yes, it is easy for me to say with no children in the military. But our lives are already at risk if Putin gets his way. So the war drums are beating. Zelensky is urging Biden and NATO to impose a no-fly zone over significant parts of Ukraine, stating that Ukraine can beat the aggressor if the Western allies do their part. This has been said to potentially dramatically escalate the war if that were to occur. Mark Rubio, Putin's legitimacy built on image as the strong leader who restored Russia to superpower after the disasters of the 90s. Now the economy is in shambles, the military is being humiliated, and his only tools to reestablish power balance with the West is cyber and nukes. Bitcoin surges above 41,000 after Putin blocks Forex transfers abroad. U.S. official, the U.S. assesses that Russia will aim to encircle Kiev in the next few days. Russian minister says we and our allies can dump euros and dollars as we cannot trust these currencies. They're now switching to the CIT system, which I believe is designed by China. So we're starting to see the dollar begin to lose some of its power as this occurs. Ukraine's President Zelensky signs EU membership application at a desk with indoor barricades behind him. Overuse of dollar sanctions could compel other actors to try to replace dollar transactions, as Russia already did to some extent following earlier sanctions, Goldman Sachs. Rudy Havenstein. If the US is trying to seriously end the dollar's reserve status, this is a good start. Next round of Ukraine-Russia peace talks to be held in coming days. Russian minister says countries can buy gas on our SWIFT, which I believe is the CIT system. Ukraine is not ready to surrender or capitulate to Russia, foreign minister says. Putin orders Russian economic counter-sanctions. The United States and its allies are contemplating releasing 60 million barrels of oil. KIP's Chinese SWIFT alternative has 1,253 direct or indirect participants. 23 of the banks are Russian, 156 are European. Tom Cotton, Biden has been shamed into taking actions he should have taken weeks ago. It's not enough. He needs to sanction Russian energy and reverse his war on American energy. According to Ukraine's defense ministry, as of 6 a.m., Russia has lost 5,300 soldiers, 29 planes, 29 helicopters, and 151 tanks. Just in, the Ukraine government received 1 million worth of Bitcoin from a single donor today. Sivan Henrik jokes, did anyone send $1 million worth of gold to the Ukraine government, highlighting its superiority in being able to move around quickly and provide easy access to capital without being regulated. Putin and Macron just spoke for 90 minutes. Doesn't look Putin is ready to back down. He said a deal is possible only if Russia's legitimate security interests are unconditionally taken into account. Cryptocurrency exchange Binance, we will not unilaterally freeze millions of customer accounts in Russia. Putin bans Russian citizens from transferring Forex abroad. Meanwhile, we've got the PMI slowing down. Tomorrow, we've got the ISM. This is all showing a slowdown in the economy, which means lower bond yields, less aggressive rate hikes, which I believe will help boost technology stocks and especially Ethereum and Bitcoin. Putin tells Macron that a neutral status for Ukraine is needed for resolution of conflict. Jim Bianco, as we await Powell on Wednesday and absorb all that news from the weekend, as of this writing, the market still has 7 rate hikes priced in for 2021 and a 21% probability of a 50 basis point hike March 16th. That's actually down to 6% as of recording this video. So when did he publish this? 7 hours ago. Many are going to find this surprising, but the answer is simple. The Fed's priority is no longer growth, but it's now inflation. They're going to start hiking and not stopping until inflation recedes. They're not going to gauge hiking's impact on growth, but inflation. I actually think markets will enjoy slow, steady rate hikes if they're not too aggressive, because it's going to help potentially get that inflation fear down. But we got to get energy costs down, and that's not going to happen during this conflict with Russia, which is probably why they made the move now. They know the financial markets are at risk of this. Bank of Japan to freeze Russian reserve assets. Russian minister says we're working on digital one world, one currency for trade. Live Monitor says winners and losers of Russia-Ukraine war. Winners, King Dollar, commodity traders, defense companies, and Janet Yellen. Losers, Putin's future, Dragon Bear, which they are referring to China, Russian sphere of influence, gold crypto economic theories. Although crypto is doing well today, he doesn't like crypto in general. EU banking sector, Xi's Taiwan dreams, and the auto sector. Joy Politano, the people saying sanctioning Russia risks the dollar's reserve currency status are very much missing the forest for the trees. China can't become a reserve currency issuer with such strict capital controls, and they aren't giving up the capital controls anytime soon. What are countries going to use? The euro, the yen? That's just inconveniencing yourself without solving the underlying problem of being reliant on the existing global financial system. And no, people aren't going to be able to settle international trade in Bitcoin, laugh out loud. The dollar is the world's reserve currency, partially because there are no realistic competitors, and partially because the US remains the world's global financial and economic hub. Neither of those things are changing anytime soon. Using SWIFT as a sanctioning tool against Russia is a long-term gamble because that's when alternatives will surface in due time. China, for one, will certainly start massive use of their cross-border interbank payment system, KIPS, with China being the top trading partners of almost all partners in that system. For lack of grand strategy, the US and others are going to find that China will profit greatly from Russia's latest invasion in Ukraine. The US found itself led by an emotionally charged EU on major financial issues. Second and third order effects on us could be grave. Making every shot count, it looks like Ukraine is striking Russian anti-aircraft convoys by hitting the mobile rockets and leveraging that rocket fuel to incinerate the entire line of vehicles and personnel. So we're in the fog of war. It's just, it's good to be protected and to take everything with a grain of salt and be patient here. Live Monitor says Russia can only stay afloat a short while before hyperinflation begins to emerge, and China can't help. This is a big thread on some of the what he calls reckless risk-taking moves by Putin, mostly assassinating people who threatened his regime, and essentially says, watch out, he might make another, I'll read the summary. With that success, his appetite has only grown, which led us to the disastrous invasion of Ukraine. In summary, this is not a man who has somehow changed and all of a sudden has become reckless. He's always been this way. Many for decades just tried hard not to notice. So he's worried that Putin's going to do something insane. Valena says, you make excellent points. However, there's a major shift in his mindset, unless he's always carefully hid it, which was revealed with Russia's full-scale war against Ukraine. And that is that he has real imperialist, revisionist ambitions, not only about Ukraine, but also Europe. Russian state-run media, RT, tells civilians to evacuate Ukraine capital. They rose their interest rates to 20% to attract capital. Here's Live Monitor's prediction. Russia expands its territory incrementally. Ceasefire this week. Negotiations in hostilities within 2 weeks, soon after talk of Putin stepping down ramps up. Over the summer, US gets its inflation scapegoat and cause the Fed to not hike as much, new quantitative easing in the summer, and a market pump for midterm elections. Supposedly there's 400 Russian mercenaries operating within Kiev to assassinate President Zelensky. Again, everything could be propaganda. We just don't know in the fog of war. Russia's internal crisis might accelerate quickly. Younger professionals in Russia have been saying today that they can no longer withdraw money from ATMs or use debit cards to buy groceries. Lots of questions about Biden's policies or non-policies during these months of what turned out to have been very accurate intelligence reporting. Nobody believed these guys after the Afghan withdrawal and so many other things that just didn't turn out true. Goldman, core services categories outside of shelter could be the next part of inflation basket to heat up. Anecdotal evidence that businesses are becoming accustomed to raising prices and wages more frequently and aggressively already point in this direction. So right now, the way I'm positioning us is the expectation that inflation peaks out in March and starts to fall into April. So we're going to pay very close attention to that forecast. Otherwise, we don't want to be so bullish on tech and growth. Goldman revising up near-term inflation forecasts. We're raising our core PCE inflation forecast to 3.7 at the end of 2022 versus 3.1 previously. So that's a massive drop. If that really plays out, we're positioned perfectly for that. Whether it's Russian war sanctions or Canada's citizen protest sanctions, 2022 has made it clear that money has been weaponized like never before in history. The ultimate deplatforming, to be removed from tools for global or local organized trade. What impact will this have? Okay, that gets us pretty far back. Here's the bond yields falling. Most importantly, the 2 years falling. This is making the expectations for rate hikes slowing down rapidly. If we go look at the CME futures market, they're only pricing in a 6% chance of a 50 basis point hike. So probably a dovish happy surprise for markets come the next FOMC minutes when they announce changes to monetary policy. Reverse repo is still sitting pretty at $1.6 trillion. That's QE buffer. Oil's not been going up during all this crazy stuff. We had a big jump early February, came back down. It's been rising. So far, Putin has not cut off Europe to energy. That could be coming if we don't get a deal soon. So hold your horses and be patient. We're looking at lumber futures and the price of oil, looking for forecasts of a sell-off. And I do think oil will sell off rapidly the second this ordeal slows down. We're probably going to have governments dump a bunch of oil in the markets to force that. So we want to sell oil the second this looks like it's going to come to a de-escalation. Gold is outperforming copper in this chart. That predicts lower yields in bonds. Baltic Dry Index has crashed some massive amount, like 70%, getting a little bit of a bid. But this is a good sign of the inflation problem slowing down. Today, we have bond yields down, energy up, and tech up over this period right here. So that's very odd. But again, the oil's up because of Russia. The yields are down because of Russia. So we got to understand that. Now, unless Putin's kicked out or they really do sign a deal, probably will stay away from RSX. It's down from just this point, 65% since November, just massive crash. Yeah, it doesn't make sense to buy it yet, too risky. Emerging markets had been outperforming the NASDAQ by selling off less, but I think getting the Russian stocks out of emerging markets caused a pretty sharp sell-off here in the last few days. So now they're trading about even. Russell 2000, good indicator of problems for the stock market, starting to get a bid back up. Europe, of course, taking some pain on all this news, jumped down below its trading range. Keep in mind, this is likely going to cause more money printing in Europe, so not freaking out about that. Again, our safe growth strategy uses a global stock portfolio. We have Europe, Asia, and North America to highly diversify capital. Dollar index, getting a bid during all this chaos. We're looking for the dollar to hit 90 within the next 12 to 24 months and to load up on the dollar and treasuries at that time and to dump all the inflationary assets. So that would be stocks, commodities, and cryptocurrencies. Long term, this could be going down towards the prices we saw in 2008. This is when emerging markets outperform US markets almost 10 times. It's just an insane return out of China. So I'm expecting for this to sell off to 90, bounce, and then over the next decade, potentially go much, much lower. So that's kind of some big timing. And again, right now that forecast is to occur based on some of the modeling from Fidelity, Goldman Sachs towards the end of 2023. So we got a long time to even hit that 90 target. No action on the Chinese currency, still trading flat. Some tech stocks, just extreme volatility. They've been getting beat up, but I believe they're about to outperform if yields are falling and we get a dovish Fed, which seems to be in the cards now. Now we're looking at Berkshire Hathaway, JP Morgan, and Bank of America as a value play over growth. So it was working while the rates were rising and tech were getting crushed, but we could be coming into a paradigm shift for the remainder of the year. Now again, more stimulus could change that, but I don't think they can pass any stimulus right now. We've been waiting for Alibaba and Tencent to outperform Taiwan Semiconductors as a sign that emerging markets is about to really take off. And so far, not happening yet. They've been trading in lockstep, but at least they're not underperforming. If I zoom out enough, you can see Alibaba and Tencent were getting crushed compared to Taiwan Semiconductors. Now they're trading correlated. Soon we should see these outperform. Here's Toyota. Again, all of this chaos is not good for the car industry, and we're seeing that hit Toyota pretty hard, down about 20% from its high. Paying close attention to that for European exposure. Exxon selling off while oil keeps going up. That's odd. Here's the yield curve spread. And so this is the flattening of the yield curves when this goes towards zero. If it goes negative, it's an inverted yield curve. And it's been heading that way for quite some time. After it inverts, typically it steepens. And it's the steepening of the long end of the bond curve that ends up crashing the stock market. So we're a long ways away from that in terms of bond market predicting a stock crash. Hasn't inverted and it hasn't steepened. So in general, the first part of this will be falling yields relative to the long end relative to the short end. So we want to be exposed to growth right now, like cryptocurrencies. This chart, we're looking at the 3 critical bond markets, and they're all up today, which was good because we'd seen the junk bond and the investment grade bond market, which supplies capital to corporations, crashing over this period of volatility. They're getting a big bid. This is very bullish for stocks. This chart, we compared Tesla to Ethereum. They seem to have quite a bit of, they seem to trade very similar. And this is showing us that Ethereum has a big gap up to catch up to Tesla currently. Now in the short term, not as big, but still about a 20% gap right there. If we go back to October, the leveraged gold and silver plays have done very well, up 25% on silver and 20% on gold. So haven't put us into that position, but watching currently. This chart, we're looking at the dollar versus treasuries with a leveraged treasury play. And we can see just how oversold these treasuries were. I'm expecting these to go right back up. But the gain we can make on Ethereum is something like double or tripling your money. If I were to put you along TMF, you might make 20 to 30%. So the main goal of bonds for me is to reduce volatility once the CPI and the interest rates line up. And I don't think that's going to occur until 2023, maybe towards the end of that year. So we're looking for a relief rally in treasuries, but lower TMF into the future. So we don't want to bet on that currently. In the safe growth strategy, we are long uranium and rare earth metals, not copper miners. And we can see the great outperformance in that. Those are some alternative energy sources to oil. And they've done phenomenally over the last several years. And we believe they will continue to do phenomenally for decades to come. Great long-term position. Just to look at the chart to see that exposure we have. Gold copper ratio fell off a cliff, predicting lower rates. And sure enough, we've got that. Okay, here's the yield curve you want in black. This was in October of 2020, right before Trump did $1 trillion in stimulus, right before he left office, and before Biden did $2 trillion. And then they overdid the stimulus and screwed up the bond market. And now they're paying the price. So now we have a flattening yield curve. We've got the front end way too high. We've got the long end way too low. They want the front end to come down and the long end to go up. And that signals that everything's hunky-dory. So far, no luck. Will rate hikes do this in getting energy costs down? Yes, I think it will. So we'll have to see that play out. And that would stop the yield curve from flattening. This chart, we're looking at the VIX futures term structure, and it is in backwardation, or in other words, the front months trade at a higher price than the future months. This is the setup you want if UVXY is going to go up 10 times in a stock crash. Okay, so if it was in contango, we would have some pain to see before this could play off. That's why today, with the SPY barely down, you saw your UVXY up as much as 12% at one point. It closed the day on 7% gain, with the SPY only down 0.26. So you can see UVXY, if shit hits the fan, this puppy is going to scream for you. So good time. Now, the other thing is if the market does calm down, this could go into contango and UVXY could fall off very quickly. So that's the catch. And why we need time getting out of UVXY the second this looks like it's going to calm down. The only asset I like better than Bitcoin and Ethereum is Polygon, ticker MATIC. You can't get this on the stock market. If you do, become a paid portfolio builder member and join our private equity deal, you're going to have big time exposure to Polygon. This is basically like the Lightning Network for Bitcoin, but for Ethereum. And you can see it's just been a screamer, dramatically outperforming Ethereum and Bitcoin by 10 times currently. If we just go back to March of 2021. So just a year back, it's outperforming tenfold. All right, here's what we're hoping for on inflation to stay positioned the way we are. I want to see the CPI top out in March. I want to see the rate of change slow down to March. So that means the February print should be no higher than 6.5, and the March print should be no higher than 7. And then April, as long as it stops going up and starts to fall, we're going to be very happy, being basically betting big on growth and falling yields, or at least stabilized yields. Same thing for the producer price index. PPI needs to stop going up. So energy costs are not going down right now. That's the only thing that's making me question my long-term outlook on the inflation and what's going to happen to the future of the bond market and what impact that will have on which asset class will outperform. Which is why, even though I keep telling you we're going to make all the money in Ethereum, we have massive inflationary hedges currently. Meanwhile, the Fed printed some more money and added it to the balance sheet. We're not quite at 9 trillion. This Thursday, maybe we hit $9 trillion. So we'll see how that plays out. The ECB is still printing with all the disruptions to the European economy due to this conflict. They're going to probably keep rates low and print money. So you want to remain long stocks in Europe. Okay, beautiful. So we're about to reveal the exact asset allocation and future trade alerts for both strategies. And this is where your video ends if you're not a paid member. So call Dean now to upgrade at 505-322-7515. We're getting you in, we're giving you the forecast, but you're not going to know when to take profits and what the next trade is until you upgrade. You're also not going to gain access to our membership area where you can punch in exactly how much money you want to invest into both strategies, and it'll calculate exactly how many shares to buy. So call Dean right now to upgrade at 505-322-7515. Okay, guys, let's go ahead and jump into